Hi, I'm Ed Alexander, business attorney and founder of Alexander Abramson. Welcome back to our partnership video series. In this video series, we're going to talk about some valuation issues about equity when you're bringing on a partner into your business. And if you haven't already looked at the prior video on bringing in a partner, go back there and take a look now. The issue in valuation, as we said before, is that if I am bringing on an employee or I am adding a partner into the transaction, there is an exchange of value, right? And so what is that value? So people look at, hey, what's my business worth? And in the last example, I gave a service business worth $150,000. Well, the equity of a business is worth, its value is related to the value of the business, but it is not just a simple math equation. And I always analogize things to buying a house because a lot of people have already purchased houses, right? And so you could own a house that's worth $500,000, right? But if you have a mortgage on that house of $400,000, then your equity in that house is only $100,000. The same thing works with a business, except we have different additions and subtractions. So of course, if there's debt on the business, we would determine first the going concern value, then we would deduct from that debts and obligations to that business, but we would also add back into it certain things like cash and cash equivalents, like accounts receivable, things of that nature. In some cases, we might even deduct an allocation for the working capital of that business. Now that's typically for larger businesses, but essentially we're taking the going concern value and we're doing some additions and subtractions to arrive at a nominal equity value. So the nominal value of all of the shares of stock or all of the membership interest. And then from there, we take a look at, hey, is this something that we could apply a discount to? And so we have discounts for maybe lack of marketability. You can't sell it without incurring some additional costs, or you can't sell it at all because the partnership agreement prevents it. Or we might have lack of control. So as a 20% owner of a business, I can't force the business to do anything, right? The majority can always impact me, always decide what that business is going to do. And so as a result, my value of my equity is worth a lot less than a controlling interest in that business. And so we've taken now going concern value, we've done some additions, subtractions, we've added some discounts to it. And so we arrive at a number that, although it's derived from that going concern value, really is not just straight on line based on that going concern value. And so that's what we have to determine before we go into a transaction. And especially if we're going into a transaction with somebody with whom the owner has a special relationship. So that would be an employee, it'd be a family member, or somebody like that. Right? And of course, going through that process is a requirement to ensure that the value exchanged for that interest is equivalent, so there isn't a negative tax complication or negative tax consequence associated with doing that deal. And of course, above all else, we want to have a really good operating agreement or shareholders agreement in place when that person comes on board. Because without that, they own the equity, and you can't require them to sell it back to you at any point in time. There's a whole host of problems. We talk about those in the partnership video series, so definitely go back and take a look at those. If you're planning a new business partnership, or if you have an existing partnership and don't have a partnership agreement or haven't reviewed that partnership agreement in a long time, call or email us to set up your partnership design session. We'll walk you through these 21 areas and set up a comprehensive partnership agreement that works for your business and that will enhance its value. Thanks for watching.